Welcome to the Deep Dive. We're the place where we dig through, articles, research, all that stuff to pull out the insights you need.
Glad to be here.
Today, we're tackling a really interesting one, a company that's, well, kind of an invisible giant in travel.
Right.
Chances are you've used their services,
Yeah.
maybe multiple times, but you might not even know their name. We're talking about Booking Holdings.
It's fascinating, isn't it? People know Airbnb, Marriott, Hilton, Expedia. Those names roll right off the tongue.
Exactly.
But Booking Holdings, it sits on top, the world's #1 online travel company. We're talking a market cap as of late April 2025, around $160 billion.
That's massive.
Yeah.
Just massive. And it's kind of hidden in plain sight.
Precisely. An empire built, largely out of the direct consumer spotlight, which makes its scale even more remarkable.
That's exactly what we want to unpack today. Our mission, if you will, is to get under the hood. How was this powerhouse built?
What makes that business model tick, How is it so resilient?
Right. And how does it navigate what has to be one of the most competitive landscapes out there? Plus, looking forward, where does it go? We've got AI shaking things up, consumer habits changing.
It's a lot to cover. We need to look at the strategic brilliance, the acquisitions, the sheer scale that lets it churn out these, frankly, astonishing profits.
Yeah, this isn't just a story about booking your next holiday. It's really a masterclass in, strategy, timing, acquisition.
And building dominance while somehow staying, like you said, invisible to many. We want to show you the hidden mechanics maybe behind your own travel plans.
Uncover some surprising facts, get to the why behind it all.
And understand what it takes to build something that lasts in this, let's be honest, brutally competitive digital world.
Okay, so to guide us on this journey, we've got a good stack of sources. We're drawing insights from Brad Gerstner's significant investment through Altimeter Capital.
Yeah, he's got a fascinating perspective.
We also have an in-depth analysis from a top investment podcast that really peels back the layers. And, of course, we've got the latest numbers, the Q2 2025 earnings reports directly from Booking Holdings.
So a really solid foundation for our deep dive.
Absolutely. Let's jump in. Often to understand a big success story like this, you have to look at the people who saw the potential early on.
Right, the visionaries.
And Brad Gerstner, through his firm Altimeter Capital, seems to be one of those. They have this knack for finding public companies that deliver almost venture capital-like returns.
It's quite a still. Think about their wins. Snowflake, Uber, Meta, Roblox, these are huge names.
Huge.
And it's not just tech, is it? I mean, look at something like Domino's Pizza, an 80x return since 2009, or Meta, 15x since its IPO in 2012. Ferrari, you mentioned, 9x since 2016.
Wow.
These are those, sit and do nothing kind of investments that most of us miss. And Gerstner's very first trade for Altimeter back in 2008, it was Priceline.
Which is now Booking Holdings.
Exactly. And it's up something like 37x since he first bought in. So, yeah, how did he get so good at spotting these?
How did he develop that eye?
Right.
What was his background? How did he get those foundational insights, especially into travel tech?
Well, his journey into travel tech actually goes pretty deep. He has a law degree, but then had an early role at a VC firm, General Catalyst.
Okay.
And that gave him exposure to companies like Kayak, which, funnily enough, later became part of Booking Holdings.
Ah, interesting connection there.
But the really key thing, I think, was his time as CEO of National Leisure Group, or NLG, from 2000-2003.
What'd they do?
They were an online cruise booking agency. So he was right there, in the trenches, dealing with the complexities, the operations, the customers, the inventory challenges.
Hands-on experience.
Exactly.
Yeah.
That wasn't just helpful, it was probably invaluable. It likely became the secret sauce in forming those later multi-billion-dollar investment decisions. He understood the nuts and bolts.
You often hear about the importance of mentorship in these stories. Was there someone who played that role for Gerstner? Someone who really shaped his approach?
Absolutely. Paul Reeder, the founder of PAR Capital Management. Gerstner actually ran PAR Capital's tech investment arm for a few years, 2005 to 2008.
Okay.
He even led their strategy moving into VC bets, like Zillow, and the influence is clearly lasting, and Gerstner apparently still talks with Reeder every week 2 decades later.
Wow, that says a lot.
It really does. Shows the power of that kind of relationship.
So Gerstner has the experience, the mentorship.
Yeah.
He decides to launch his own firm, Altimeter, in 2008. But talk about timing, right into the teeth of the global financial crisis.
Yeah, the timing couldn't have been worse, seemingly.
How did he even manage to get it off the ground?
Well, this is where it gets really interesting. It's a lesson in resilience. He was financially independent, but starting the firm was still a big leap. He initially got hundreds of millions in commitments lined up from endowments.
Okay, sounds good so far.
Then 2008 hits, bang, those commitments just evaporated. Poof, gone. His venture almost died before it even started.
That's brutal.
Totally. But he was inspired by guys like Seth Klarman, his mentor, Paul Reeder people, who also started small. So he just pushed forward with only $3 million raised from friends and family.
Just $3 million, after aiming for hundreds.
Yep. High risk, high potential. It really proves that sometimes the biggest opportunities emerge from crises if you have the nerve to grab them.
Incredible story.
Okay.
So that's the investor. Now let's turn to the company itself. Priceline, the original seed of Booking Holdings, launched back in 1997.
Right.
And they came out with this really groundbreaking idea, name your own price.
It was brilliant. A total win-win. Hotels and airlines could get rid of unsold inventory. Empty rooms, empty seats quickly without publicly slashing their prices.
Affects the brand value.
Exactly. And consumers, they got amazing deals. There was huge excitement. William Shatner was even their spokesperson.
The negotiator.
Yeah.
I remember those ads.
He famously got stock, too. Though the story goes he sold it way too early. Ouch.
Oh, man. Classic. So Priceline was riding high on the dot-com wave. And like many companies then, they got ambitious. Very ambitious.
Extremely. They thought, hey, if name your own price works for travel, why not? Everything else.
So what do they try?
Oh, you name it. New cars, mortgages, gasoline, even groceries. There was even a site called Perfect Yard Sale for, used lawnmowers.
Well, talk about diversification. Or maybe overreach.
Definitely overreach. It all came crashing down when the dot-com bubble burst. Suddenly, all these internet companies with huge cash burn rates had nowhere to go, no more funding.
A familiar story from that era. But Priceline didn't die, they survived. How?
They retreated strategically, fell back onto their core travel business, which is actually still pretty strong. They decided, okay, let's just focus on hotels, rental cars, flights.
Back to basics.
Exactly. Adaptability was key. They ran a Super Bowl ad in 2002 that brought in a lot of organic traffic. But crucially, they also started offering full-price travel options alongside the bidding model.
Becoming more of a one-stop shop.
Precisely. And here's something fascinating. Priceline had this built-in downside protection.
How so?
Well, think about recessions. People get more price sensitive, right? They hunt for deals.
Makes sense.
And at the same time, hotels and airlines have more empty inventory they need to shift. So Priceline actually thrived when times got tough.
Counter-cyclical, almost.
Sort of, yeah. By 2003, they were cash profitable again. That was huge. It reopened the capital markets for them, made their stock options valuable again for attracting talent. It sent a signal. Priceline was back in business.
Okay, so they survived the bust, refocused, got profitable. But just surviving isn't enough for empire building. They needed to look beyond the U.S.
Escapely. The next phase was conquest, and they set their sights firmly on Europe.
Why Europe specifically?
The playbook was crystal clear. Become the top online hotel reservation service in Europe. They saw two key things. One, the international market was way bigger than the U.S. domestic market. And two, Europe was adopting online travel booking really fast. It was a fast follower market ripe for growth.
So the strategy was clear. And now they have the cash, thanks to that profitability.
Right. And they chose acquisition as their weapon of choice. Some might call it the sugar daddy playbook, using their cash to buy growth overseas.
And they went on quite a shopping spree.
Oh, yeah. It was a masterclass in M&A, looking back. Active Hotels in 2004. Then the big one. Bookings BV in 2005. Agoda in 2007. Travel Jigsaw, now. Rentalcars.com in 2010. Kitech in 2013. OpenTable in 2014.
The list goes on.
It does, right up to Hotels Combined in 2018. This wasn't just random buying, it was strategic assembly. Piece by piece, building a global powerhouse.
Let's dive into that Booking.com acquisition in 2005. Feels like the pivotal moment. But you said Bookie's BV, as it was then, was actually struggling. It's hard to imagine now.
It is, isn't it? But yeah, according to an early employee, they had serious cash flow problems.
What was the issue?
It was the timing of cash flows. They had to pay Google for ads upfront, mostly in the first half of the year, to drive bookings for the summer.
Okay, makes sense. Need to advertise before the peak season.
But they didn't actually get the revenue from those hotel stays until the second half of the year, after people traveled. It created this huge gap, a working capital crunch.
I see. So they needed cash to bridge that gap.
Exactly. And Priceline, now profitable and flush with cash, stepped in. They provided that crucial capital injection. It was a perfect win-win. Priceline got this incredibly fast-growing European asset.
And Booking.com got the fuel it needed to keep accelerating.
Precisely. Solved their bottleneck.
So initially, Booking.com plugged into Priceline's infrastructure, servers, engineers, that sort of thing.
Yeah, that was the initial plan. Leverage the existing setup. Makes sense for integration.
But Booking.com's growth was explosive, right?
Too explosive, almost. It quickly outgrew what the mothership could provide. So the decision was made to actually separate Booking.com's infrastructure, let it build its own, run independently under its CTO at the time, Brendan Bank.
Interesting. So decentralization became necessary.
It shows that flexibility, right? It's contextual. Like Berkshire Hathaway, sometimes centralized control makes sense. Other times decentralization fosters speed and innovation. There's no single right answer. It depends on the stage and the specific needs.
And what about the culture? The Netherlands has this reputation for being very entrepreneurial. Booking's BV sounded like a classic scrappy growth hacker. How did Priceline avoid crushing that spirit?
That's maybe the most impressive part. I mean, get this. Even when their marketing budget hit something like $100 million, they supposedly only had 2 people in the marketing department.
2 people.
Incredible efficiency. But the key was Priceline's philosophy. Let the acquired companies run independently. Even let them compete with each other.
A hands-off approach.
Very hands-off. It allowed Booking.com's unique culture, data-driven, obsessed with measurable results, super entrepreneurial to stay intact. That's rare for a big corporate acquisition. They empowered it, they didn't smother it.
And that data-driven approach really became their superpower, especially after merging with active hotels.
Absolutely. They just went all in on aggressive, data-backed strategies to conquer Europe. They became masters of Google search ads.
We heard they were Google's biggest customer for a while.
Unofficially, yes. They were spending billions a year on Google, but with a very high ROI. They even built their own proprietary tools to manage it, stuff that went beyond what Google itself offered.
And they operated in stealth mode.
Yeah. Kept a low profile, helped limit things like DDoS attacks and fraud, but the core focus was always measurability. Every euro spent had to be tracked and justified by results.
That relentless focus clearly paid off. The subsidiary, Booking.com, became utterly dominant.
So dominant that the parent company eventually had to acknowledge reality.
Which led to the big name change in 2018.
Exactly. Priceline Group officially became Booking Holdings. It was a clear signal. Booking.com wasn't just part of the group, it was the group, essentially. It drives something like 90% of the revenue today. The student truly became the master.
Okay, so we've got the origin story, the empire building through acquisition. Let's pivot to the engine itself, the business model. At its core, it sounds simple. Be the middleman.
It is elegantly simple, yet incredibly powerful. They connect travelers with suppliers, hotels, airlines, car rentals. Think of the old school travel agent your parents might have used.
Right.
Booking Holdings basically digitized and scaled that function massively. They help suppliers fill inventory that expires quickly. An empty hotel room tonight is lost revenue forever.
And the key to their dominance seems to be this powerful two-sided network effect. Can you break that down?
Yeah, it's a classic flywheel. Think of it like a marketplace. The more suppliers, hotels, airlines list on Booking.com, the more attractive it becomes to travelers because there's more choice.
Makes sense. More options, better for me.
Right, and the more travelers flock to the site, the more essential it becomes for suppliers to be listed there because that's where the customers are.
So each side feeds the other.
Exactly. It creates this self-reinforcing loop. Consumers go there for the widest selection. Hotels have to list there to reach the consumers and fill their rooms. It builds this incredibly strong competitive advantage, this moat that's really hard for others to breach.
And they make money in 2 main ways, right? The agency model and the merchant model.
Correct. 2 distinct approaches. First, the agency model. This is where you, the customer, book online, but you pay the hotel directly when you stay. Booking.com just takes a commission from the hotel afterwards.
Okay, pay at the hotel. That was their initial big push in Europe, right? Very customer friendly.
Exactly. No upfront payment, flexible. Then there's the merchant model. Here, Booking essentially buys the room nights from the hotel at a wholesale rate and sells them to you. You pay Booking directly when you book.
Ah, so Booking handles the payment up front.
Right. And that means Booking gets to hold on to your cash until your actual stay. That cash is called float.
Like insurance companies use float.
Similar principle. It's basically an interest-free loan they can use for operations or investment. And this merchant model has grown hugely for them. In 2019, it was less than half their agency revenue. Now, It's $14 billion in merchant revenue versus $8.5 billion in agency revenue.
Wow, that's a big shift.
It is. It also deepens the customer relationship because Booking handles the whole transaction, gives them more control, more data.
Now, you mentioned Europe earlier. There's a specific reason Booking.com took off there first, before really cracking the U.S. market, tied to the hotel landscape itself.
Yes, absolutely. The market structure was key. In the U.S., something like 2/3 of the hotel market is dominated by big chains, Hilton, Marriott, Hyatt, etc.
They have their own loyalty programs,
Yeah.
strong brands.
And significant bargaining power with online travel agencies, the OTAs, like Booking. Europe, on the other hand, is much more fragmented. Lots and lots of independent hotels, many with 50 rooms or fewer.
Smaller players.
Exactly. These smaller hotels don't have the marketing muscle or the brand recognition of the big chains. They need Booking.com's massive marketing spend and sophisticated platform to reach customers and fill those rooms.
So Booking provided the distribution they couldn't achieve on their own.
Precisely. And starting with that easy-to-adopt agency model in Europe was a brilliant strategic move. It got those fragmented hotels onto the platform quickly and built that critical mass on the supply side.
When you compare Booking Holdings financially to its main traditional rival, Expedia, the difference is just stark.
It's mind-blowing, frankly. Let's look at some 2024 numbers. Gross booking value, or GBV, the total value of travel sold, Booking hit $165 billion. Expedia, $110 billion.
Okay, so Booking is about 50% bigger on the top line.
Right, but now look at operating profit. Booking made $7.6 billion. Expedia, only $1.3 billion.
Wait, so Booking's profit is almost 6 times higher, even though their sales are only 50% higher?
Exactly. That tells you so much about the underlying efficiency and profitability. And it shows up in the market cap. Booking's is over 7 times larger than Expedia's.
What other metrics highlight this difference?
Return on invested capital, ROIC. It measures how well a company uses its money to generate profits. Booking's ROIC is over 40%. Expedia's is just 6%.
40% versus 6%. That's a huge gap. Shows a much stronger competitive moat for Booking.
Absolutely. Look at margins, too. Net margins. Booking 25%, Expedia 9%. Owner's earnings margin, a key metric favored by Warren Buffett, Booking 33%, Expedia 18%.
So across the board, Booking is significantly more profitable and efficient. Why? Lower customer acquisition costs.
That's a big part of it. Their marketing is cheaper as a percentage of revenue. Better synergies between their various brands, too. It all just translates into much higher cash generation and profitability. They're just fundamentally better at turning bookings into profit.
This brings us to their competitive advantages, their moats. We've touched on some, but let's spell them out. Number one has to be sheer scale.
Unmatched scale. It allows them to do things smaller players just dream of. They can hire the absolute best engineers, the best marketing minds.
And invest heavily in technology.
Continuously. Optimizing websites, improving conversion rates, experimenting with AI. That scale creates a virtuous cycle. Better tech attracts more users, which generates more data, which allows for better tech. It just reinforces their lead.
Moat number two, global brand recognition and trust. Especially important when traveling internationally.
Hugely important. You land in a foreign country, you see a name you recognize, you trust. Booking operates in over 220 countries and territories. That global ubiquity builds familiarity, reduces friction, builds loyalty across incredibly diverse markets.
And they're actively building on that loyalty with the Genius program. It's not just about getting the first booking.
No, it's about keeping you in their ecosystem. And Genius is clever. It spans across their brands, Booking.com, Priceline, Kayak, Agoda. You earn points, you get perks, discounts of 10, 20%, free breakfast, room upgrades.
Makes you want to stick with them.
It really does. And look at the impact. The higher tiers, level 2 and 3 Genius members, book over half of all Booking.com's room nights.
Wow, over 50% from top-tier members.
And crucially, they have much higher direct booking rates, meaning they come straight to Booking.com, not through search engines. It's a powerful retention tool and a growing competitive advantage, especially since Airbnb, for instance, doesn't really have a comparable cross-brand loyalty scheme yet.
And the fourth moat, perhaps less obvious but powerful, smart capital allocation.
Yeah.
You call them a share cannibal.
Yeah, it's an apt term. They are relentless buyers of their own stock. In 2024 alone, they bought back and retired nearly 7% of their outstanding shares.
7% in 1 year.
It's aggressive. That creates significant value for remaining shareholders. The share buyback yield was around 4% as of April 2025. That's a powerful return mechanism, even alongside the cash dividend they started paying, which was $9.60 per share for Q3 2025. It shows a commitment to returning capital efficiently.
Okay, let's shift gears to the competitive landscape and future challenges. First up, the big one, Google. Their relationship is complicated.
Deeply complicated, a classic frenemy situation, as you said.
How so?
Well, Booking is one of Google's absolute biggest advertising customers. We mentioned the billions they spend. Over $3 billion of their $7.2 billion marketing budget went to Google Ads in 2024.
So Booking needs Google for traffic.
Absolutely. But Google also needs Booking's ad dollars. It's a huge chunk of revenue for Google search. So they're interdependent, locked in this dance. Neither can really afford to walk away.
People have predicted for years that Google would just crush the OTAs and enter the travel booking space directly. Why hasn't that fully happened, especially in hotels?
Google has tried. Google Flights was pretty successful, definitely disrupted meta search players like Skyscanner. But hotels, their efforts have been, let's say, mixed.
Why the hesitation? They have the search dominance.
Several reasons, I think. One is the risk of alienating huge advertisers like Booking and Expedia and losing those billions in ad revenue. That search profit pool is just too valuable for Google to jeopardize easily.
Cannibalizing their own ad business.
Potentially. And the other factor is travel fulfillment is messy. It's complex. Payments, customer service, managing relationships with thousands of hotels, dealing with regulations in different countries.
It's operationally intensive.
Very. As Booking CFO put it, travel looks attractive on the surface, but it's complex and messy below the surface. Google seems reluctant to dive headfirst into that operational complexity when their core search business is so profitable and clean.
But Booking isn't just relying on Google's hesitation. They're actively trying to reduce that dependency, right?
Definitely. It's a strategic priority. They're pushing hard to drive more direct traffic,
Ah.
primarily through their app. The percentage of room nights booked via the app skyrocketed from 30% in 2019 to 55% in 2024.
That's a huge shift, getting people into their own walled garden.
Exactly. And they're also investing heavily in brand advertising, Super Bowl ads, sports sponsorships, trying to build that top-of-mind awareness so when people think travel, they think Booking.com directly, not just search for hotels near me on Google. It's about owning the customer relationship.
Okay, let's talk about the other major challenger, Airbnb. As Brad Gerstner said, to compete with Booking or Expedia, you need something 10x better or just different. Airbnb was definitely different.
Totally different. They didn't just offer another way to book hotels. They created a whole new category. Staying in someone's spare room, renting a whole house, a unique experience, not just a place to sleep.
It was truly disruptive to the traditional hotel industry.
Hugely disruptive, posed a massive threat, forced everyone to react.
And Booking did react. They didn't just sit back. They built their own alternative accommodations business. How's that going?
Phenomenally well, actually. They now list 8.4 million alternative accommodation properties. That's up 8% year over year as of Q2 2025.
How does that compare to Airbnb?
It's actually more listings than Airbnb's estimated 6 million or so unique listings, and it's a significant part of Booking's business now. About 37% of their room nights in Q2 2025 were for alternative stays.
37%. That's huge.
And that segment grew 10% year over year faster than their core hotel business. There was even a quarter, Q4 2024, where Booking's alternative accommodation growth at 19% outpaced Airbnb's overall growth of 12%.
So they've built a serious competitor to Airbnb within their own platform.
Absolutely. It shows their ability to adapt and compete effectively, even against major disruptors.
Now, if you've used both platforms, the user experience feels quite different.
It does. Airbnb is very visual, sleek, great photos. It appeals to people seeking unique, maybe less price-sensitive stays. It feels curated.
Right. Booking.com feels more...
Functional, exactly. Maybe a bit cluttered to some eyes. But it offers tons of filters, detailed information, side-by-side comparisons. It excels at helping you find a standard hotel room or apartment that meets specific criteria at a good price.
So they cater to slightly different needs or preferences.
I think so. Some prioritize that unique aesthetic and experience curation. Others want the widest selection, detailed comparisons, and maybe more consistency, especially for traditional hotels. There's room for both.
It feels like a race now. Who can become more like the other fastest? Airbnb adding hotels, Booking mastering alternative stays.
Right. But Booking's CEO, Glenn Fogel, has said he doesn't really care what type of accommodation people book: home, hotel, villa, igloo.
He just wants to book it on Booking.com.
Exactly. His goal is to provide the best choice and the best tools to find what you want, not to steer you towards one type or another. It's a flexible, agnostic strategy that allows them to capture demand across the board.
Beyond specific accommodation types, Booking has this grander vision, the connected trip. What's the idea there?
It's about moving beyond just booking a single component, like a hotel, to integrating the entire journey. Flights, accommodation, rental car, maybe even tours and attractions, all seamless, all personalized, all within the Booking ecosystem.
Creating a one-stop travel platform.
Precisely. And the data shows it works. Customers who book multiple things, flight plus hotel, for example, show much greater loyalty and higher direct booking rates.
Is it gaining traction?
It is. Connected trip transactions grew over 30% year over year in Q2 2025. It's still a low double-digit percentage of their total transactions, but it's growing fast and is clearly a key strategic focus.
What are the key enablers for this connected trip? It sounds complex to pull off.
Two main pillars, really. First is payments. Having their own integrated payment system allows them to bundle things, offer better pricing, create value for partners, and of course, benefit their own bottom line.
Smoother checkout, maybe offer unique package deals.
Exactly. The second pillar is the Genius Loyalty Program. Extending it across all these different travel components, flights, cars, attractions, not just hotels, acts like glue. They can use data to offer personalized perks from suppliers across the whole trip, driving more sales and loyalty.
And this vision isn't just good for the traveler. It helps their partners too, especially the smaller ones.
Yes, that's a crucial part of the ecosystem. Many of Booking's partners are small or medium-sized businesses, independent hotels, local tour operators, car rental agencies. They don't have the tech or marketing budgets of the big players.
Right.
The connected trip platform gives them access to customers they might never reach otherwise. Booking can intelligently bundle their offerings, presenting them to the right traveler at the right time. It provides incremental business for them and strengthens that two-sided marketplace.
Okay, let's talk about the next potential disruption.
Yeah.
Artificial intelligence, AI. Just like the internet disrupted travel agents, AI could be the next big shift.
It absolutely could be. History shows that platform shifts often create openings for new tech-native companies to disrupt the incumbents, and travel is a huge profit pool, always attracting innovators.
So how is Booking Holdings preparing for this? Are they just watching, or are they playing offense?
They are definitely playing offense. They're not just aware, they are leaning heavily into it, as they say, investing significantly in advanced AI capabilities.
How are they using it?
Leveraging their massive trove of proprietary data is key. They're building tailored, time-saving solutions. We're seeing early examples like Penny, Priceline's AI travel assistant. Kayak has Kayak.ai as a testbed for AI-first features. OpenTable is using AI for its concierge service, offering personalized restaurant recommendations based on deep data.
So integrating it across their brands.
Yes, trying to make the whole experience smarter, more personalized, more efficient.
And is it already having a noticeable impact?
It seems so. They've reported that generative AI has notably reduced live agent contact rates.
Meaning AI is handling more customer service queries.
Exactly. Answering questions faster, resolving issues more efficiently, which apparently improves customer satisfaction scores. Think about an AI automatically rebooking your dinner reservation if your flight gets delayed. That's the kind of seamless integration they're aiming for.
And they're partnering with the big AI players.
Yeah, collaborating with OpenAI, Microsoft, Amazon, staying close to the cutting edge, making sure they have access to the latest developments.
Now, Booking's leadership, like CEO Glenn Fogel, they've been around the block. They've seen threats come and go. How confident do they sound about navigating AI?
They sound pretty confident, grounded in realism. They understand the operational complexity of travel, that messy below-the-surface aspect we talked about. Fulfillment, payments, customer service requires specialization.
It's not just about having a cool AI chatbot.
Right. Their view seems to be that they can adapt, integrate AI effectively, and if a truly disruptive AI-native travel startup emerges, well, they have the scale and the cash flow to potentially just acquire it.
Like Meta buying Instagram.
Exactly. Pull another rabbit out of the hat, as one analysis put it. Buy the disruptor before it gets too big. They have a history of successful acquisitions, after all.
Let's look closer at management and shareholder value. Glenn Fogel, CEO since 2017, but with the company since 2000. Shares are up over 200% under his CEO tenure.
Yeah, significantly outpacing the S&P 500's 130% return over the same period. A strong track record.
He's highly compensated, though, right? $46 million in 2023.
He is. It's mostly stock awards and bonuses, not base salary. And while $46 million is definitely high compared to the average S&P 500 CEO's $15 million, his pay is tied to performance metrics.
Like what?
Revenue growth, total shareholder return, EBITDA growth. And he has delivered. Compounded the share price around 25% annually over the last 3 years, with strong revenue and EBITDA growth alongside that. So while high, the pay seems aligned with delivering results for shareholders.
Now, what about stock-based compensation overall? Does it dilute shareholders excessively? That's always a concern with tech-heavy companies.
It's something to watch, for sure. But Booking seems to manage it reasonably well. Their dilution rate was only about 0.3% in 2024, which amounted to $600 million.
How does that compare?
Well, compared to Airbnb, whose dilution rate was around 2%, costing shareholders $1.4 billion in 2024. So Booking's approach seems much more optimized for long-term shareholder returns, less dilutive. It points to good financial discipline.
Okay, let's zoom out to the investment perspective. The overall online travel market is expected to keep growing nicely.
Yeah, the projections are strong, around a 10% compound annual growth rate, or CAGR, over the next 5 years, going from roughly $650 billion to nearly $950 billion globally.
That's a strong tide lifting all boats, but especially the biggest boat.
Exactly. Booking is perfectly positioned. They expect their own revenue to grow around that 10% mark, maybe slightly faster, but earnings should grow even faster because of operating leverage.
Meaning costs grow slower than revenue.
Right. As they scale, their margins should expand. And remember, we're still only in the middle or slightly later stages of hotel booking, moving online globally. There's still plenty of runway, especially in developing markets.
So you put all that together, market growth, margin expansion, buybacks, maybe a small dividend.
Yeah.
What kind of return could investors reasonably expect?
If you make some conservative assumptions, say a reasonable valuation multiple like 20 times EV, but factor in the small dividend yield, less than 1%, and that significant buyback yield of around 4%, you could plausibly pencil out a 12–14% expected annual shareholder return.
And how does that compare to the broader market?
It compares very favorably. The S&P 500 is maybe expected to grow earnings at 5–6% annually over the next decade. So Booking potentially offers double that return, makes it look quite attractive from a long-term compounding perspective.
And where is the future growth coming from, beyond just more online hotel bookings?
Several areas. The rise of the global middle class, especially in Asia, is a huge tailwind. As people get wealthier, travel is one of the first things they spend more on.
It's a fundamental human desire.
It really is. Then there's the expansion into new segments. We talked about alternative accommodations, that's growing fast, but also flights.
Flights, I thought they were mainly hotels.
They're getting much bigger in flights. They booked 50 million flights in 2024, generating $13 billion in gross booking volume. That was up 38% year over year.
Wow, 38% growth in flights. That's significant.
It is. And they also see potential down the road for building an advertising business, leveraging their traffic like Kayak already does, or like Expedia is starting to do more. Another potential high-margin revenue stream.
Let's look at the very latest performance. Q2 2025 sounded strong.
Very strong. Exceeded their own expectations. Room nights were up 8% year over year, hitting 309 million.
Where was the strength geographically?
Good performance in Europe, high single-digit growth, even stronger in Asia, low double digits. And the U.S. market also improved, growing in the low single digits, but outpacing the overall U.S. travel market.
And the financial metrics?
Gross bookings up 13%, revenue surged 16% to $6.8 billion. Adjusted EBITDA, a key profit measure, grew an impressive 28% to $2.4 billion. And adjusted earnings per share jumped 32% to $55.40.
That EPS growth outpacing EBITDA growth, that's the buybacks kicking in.
Exactly. Helped by a 5% lower average share count. It really shows the power of that buyback program boosting per share results.
And this performance isn't just luck. It reflects those strategic initiatives we discussed paying off.
You can really see the pieces coming together. They highlighted tangible progress in strengthening direct customer relationships. That direct booking mix is now in the mid-60% range.
Cutting out the middleman, like Google.
To some extent, yes. And the mobile app mix is in the mid-50s. The Genius loyalty program keeps growing those valuables. Level 2 and 3 members now make up over 30% of active travelers.
Connected trip growing too.
Yep, transactions up over 30% year over year. And those non-accommodation areas are flying flights up 44%, attractions revenue more than doubled. It's becoming a much more diversified business.
What about the outlook? Any slowdown expected?
Well, Q3 faces tougher comparisons to last year, and there's always geopolitical uncertainty. So for Q3, they guided Slightly lower room night growth, maybe 3.5, 5.5%. Gross bookings up 8-10%, revenue up 7-9%.
Still solid growth, though, and the full year.
Full year 2025 outlook remains strong. Constant currency gross bookings and revenue still expected up high single digits, but adjusted EBITDA expected up mid-teens and adjusted EPS up high teens.
So profits growing significantly faster than revenue. That's margin expansion.
Exactly. They expect margins to expand by about 125 basis points for the full year. Management calls this their double discipline.
Double discipline. What's that?
It means being disciplined on two fronts simultaneously. One, driving operating leverage through efficiency. They have a big transformation program underway, expected to save $350 million annually when fully implemented, with $150 million of that hitting this year.
Cutting costs, becoming leaner.
Right. But discipline number two is aggressively reinvesting those savings and profits into growth initiatives. Things like generative AI, fintech capabilities for payments, building out those new verticals like flights and attractions.
So cut costs in mature areas to fund growth in new ones.
Precisely. It's that powerful combination. Rigorous cost management fueling bold, forward-looking investment. That's the engine driving that strong profit growth outlook.
It really is a remarkable story. Booking Holdings navigating dot-com busts, financial crises, a pandemic, constantly adapting, leveraging scale, data, smart acquisitions, now facing AI, the connected trip vision, new competitors. It's fascinating.
It never stops in the travel industry.
So here's a final thought for you, our listener, to mull over. Given everything we've discussed, their deep moats, the loyalty program, the relentless efficiency drive, global diversification, the big bets on AI, and the connected trip, which one single aspect of Booking Holdings strategy do you think will be the most critical for them to continue dominating the next decade of travel?
Is it the tech, the scale, the loyalty, the operational grit?
Something to ponder perhaps on your next journey. Thanks for joining us on The Deep Dive.